Hello traders, Namaste. We have 5 consecutive negative weeks from the Nifty 50 and at the current price of 15,783, index has come very close to its previous swing low. In this video, we will take a much deeper look. What are the various factors? Why is inflation so important? What about the Russian-Ukrainian war and what are the key levels? Is the market expected to fall more, or can we expect a bounce back? So we will discuss this at length in this video. Keep your patience, hear me out, and do let me know about your thoughts. So here we are on the mind map, which I feel will give you a better, clearer picture of the way I look at the current market scenario. So I have the state of the market, and on the two sides I have factors which I think are affecting the current market situation, and what can we expect from the trend and the volatility. So let's first take a look at the factors. The way I look at it, external factors is the US situation and the Russia-Ukrainian war. You can also think of inflation, but when we talk about the US condition, the inflation will anyways trickle down here as well. So what about the US inflation? The US inflation at the current juncture is at a 40-year high. It's a very, very high inflation in relative terms. We can take a look at the inflationary chart, the chart of inflation, This is the Trading View platform, and I can see it's around 8.3%, which is significantly higher. It had a great bounce back from this level to this. And the levels that we are looking at, we last saw these levels back in Jan 1982. So it's a 40-year high level for the inflation. So this inflation that we are looking at, high inflation, okay, prices have gone up. So what will it do if the inflation, if the prices of general goods and services in the country is generally going up, slow and steady, inflationary condition? We need to understand that how much of this inflation is cyclical and how much of it is supply driven. What do I mean by this is everything has a cycle. So inflation too has a cycle. And when the inflation rates are very low, they generally tend to pick up like a cycle. But in this case, we have seen the pickup is exponential. It's very fast. So we need to also understand that how much of this is cyclical and how much is it supply driven. And supply driven, so the war with Russia, the crude has a very important role to play here. So what happens when a country faces steady rise in goods and services, or when the country faces some inflation? What will the Fed or what will be the central bank like to do? What they would like to do is essentially suck in the liquidity from the system. When the system is flushed with a lot of liquidity, in this case cash, money supply, it's very important for the central bank to take that liquidity, excess liquidity from the system. And how will they do that? A very simple monetary policy that they do is they will increase the rate of interest. If they increase the rate of interest, if the central government starts to offer bonds at a higher rate of interest, then money will find it safer to park in with the bonds of the country, which are very unlikely to default. And so it will suck in the liquidity back from the system into the central bank. So they will increase the rate of interest. We have already seen this happening in the US markets, and we can expect this entire 2022 that they might continue to increase the rate of interest because they have to suck in a lot of liquidity. Don't forget the quantitative easing that we had seen in 2008. Don't forget the quantitative easing that we have seen in March 2020. So the system had a shot of, let's say, steroid. The health of the economy was not getting back to its feet. Antibiotics were not working. So you need a shot of a steroid, and that's exactly what was given. And now the reverse needs to be done. The reverse needs to be done, and liquidity needs to be taken back. So rise of rate of interest. As you increase the rate of interest, the bond yields will, the spreads will reduce. The bond price, the rate of interest will have a direct impact. Let's take a look at the most favored spreads is the 2-year US bond yield and the 10-year bond yield. On this particular chart, we are looking at the orange line, which is the 2-year yield curve, and this is the 10-year yield curve. You can notice right at this juncture, the 10-year is still above the 2-year, but they are very, very close to each other. And when they come very, very close to each other, it causes for concern. And when the 2-year goes above the 10-year, that is flips above the 10-year, it's called an yield curve inversion, inverted yield curve, which is generally considered since the 1980s or even before that, it's considered to be a sign of upcoming recession. So let's take a look at this data as much as TradingView is offering me. So I've got some nice data from mid-1980s to the current juncture. And I can mark for you over here few areas where the two curves had come very close to each other. They may or may not have inverted, but they had come extremely close to each other. I can see right now around 6-7 instances. In fact, I should have marked this with the rectangular tool that we have on TradingView. Okay, I will come to that. That's the chart of NYMEX crude. That's the chart of crude in NYMEX, to be precise. Okay, so what I'm going to do first is I'm going to mark these zones wherein in the past we can visually see that yes, these two yield curves had come extremely close to each other, and then we will bring in the S&P 500. Let's bring in the S&P 500. So there you are. This is the S&P 500 index, equity markets, and let's try and understand how what were the repercussions. So we will get some mixed cues. Okay, let's see first. So if we get a vertical line, very clearly 2008. This is 2007-8 top, one of the sharpest bear markets that I have at least ever experienced. This one came very close. It was a shallow correction. Then we have the coronavirus here, right? This one. Now we are at the current juncture. I'll mark it. So it came close very here at this juncture. Let's take a look at the past. When we take a look at the past, this is the 2000 bubble. The yield curves inverting. During this period, it did not actually matter at all to the equity markets. Then over here, this is 1990s. We have a bit of correction. So size wise, I think we can just do an approximate. This will not be a perfect exact kind of a understanding, but approximately this is around 27% kind of a correction that we noticed. This correction was around 62%. These are all approximate numbers. I'm just dropping them just to figure out. 2007-8 gives me around 72% kind of correction. At the current juncture, more or less, we are around 15-16%. S&P 500 is 23%. So whenever these yield curves come close to each other and they tend to inverse or show signs of inversion, they can lead to economic recession. There is a logic behind it. I'll show you the logic with the mind map. But another important thing that we need to understand is the play of crude at this juncture. How is crude playing out? And that's why I had that blue graph. Yes, this might get a little cluttered, but what is important to notice is we are at this juncture of the yield curves coming close to each other, and this is where the crude prices are. The last time we had a very close yield curve, this was where the crude prices were. Okay, and if you take a look at the earlier instances, this was 2007-8. This was the top of the market, and at that juncture, this was where the crude was, and the crude had a great. So whenever we have this yield curve inversion, or both the yield curves coming close to each other, we generally have noticed an increase in rising crude prices. Either prices have already risen. In all the last three cases, we have noticed they have already taken up movement. They had already started to gain momentum, and that's exactly what's happening here. So it's not a coincidence that we see that the 2-year, 10-year bond yield curves coming close and inverting in a situation, in a scenario where crude prices are already picking up, have already started to run up. Now what this happens, it slows down the capital flow of the market. You would notice that recently in Indian markets also, the RBI came up and increased the repo rate by 40 basis points, and this is likely to probably continue, and they will keep a very close look quarter by quarter. These are macroeconomic parameters. This is not something that can be done overnight. It takes time, and observations are very important. So when you start to increase the rate of interest to cool down the inflation, rate of interest goes up, bonds becomes relatively more attractive for the money, because that's where governments will issue some bonds and suck in the liquidity from the system. As the rate of interest goes up, companies, businesses find it difficult because their cost of capital increases. The loans based on which they are doing their businesses, those loans becomes expensive. Situation is such that financial institutions and banks will be little hesitant to be open-handed and allow capital to risky businesses. So those who do not have a good profile will find it difficult to raise capital from the banks or get loans from the bank. Raising capital from the public will become very difficult because it's an economic slowdown that is happening. And so after this slowdown, what we tend to see is a recession. This is the logic. I have taken this definition from Investopedia. The recession is a period of declining economic performance across an entire economy that lasts for several months. Especially what they look at is 2 consecutive quarters of decline in real GDP. So by the time that happens, markets would have already corrected a good 30% or so. We are already down, I think, 15%, 16% on a high to low basis. So this is essentially the scheme. This is essentially the scheme of things in which things can unfold. Now what I would like to do is take a look at the other side. The crude impact coming from the Russian-Ukraine war. If you look at it, firstly, I would say that uncertain. Uncertain in the sense that the war did start some time back. The war used to make the front page news. Now it has probably gone 3-4 pages back unless something important happens. So it's happening, but the world has decided to live with it. And all wars come to an end. A good end, a peaceful end, a nasty end, but it always comes to an end at a very, very big price. So it is uncertain, and all of a sudden we can next day morning can check the news and see that the war has stopped. If the war stops, it will give a good sentimental, emotional boost to the market. Prices might jump up for a short span of time. That can be a good thing. But the markets are not coming down or have come down completely because of the war or completely because of the crude. There are various other elements. Now take a look at the play of the crude. Of course, the crude in itself is very volatile. We'll take a look at the chart of crude. And of course, if crude prices goes up in a country like India, where I think the maximum import comes close to, I think, $120 billion of imports happen from by India and they buy crude from various different countries, inflation is of course a very, very direct impact. We heavily rely on crude. So inflation at our end is also going up. I'll show you. Rate of interest, as I just mentioned, the RBI governor had recently increased the rate of interest, and it will probably stay the trend if inflation is not under control. Let's take a look at the chart. This is tradingeconomics.com, and under India prices, I have clicked here inflation rate. So you can see over here that the steady increase in inflation, and on an average, if you see, the threshold was around 5 to 6%. Then from Jan onwards, actually it's increasing from October, November, December, Jan, Feb, March, April. So October wouldn't have worried you much. November may not have worried you much, but from 4.9 to 5, from December onwards, this was getting a little, disturbing. And now, of course, it is disturbing. So the governments, the central banks will keep a close look, observe these numbers, and then take a call. They cannot immediately increase the rate of interest, because in December it went from 4.48 to 4.91 or 4.91 to 5. It doesn't work. Now it has got into an uncomfortable zone. And so when the reverse also happens, by that time market will discount it. So if I show you the max information that TradingView gives me here since 2012 to the current condition, 10 years, we had a little bit of inflation in around 2013, which is close to this level, and this is around 12%. So we're okay. We've been a country where we have seen higher double digits in inflation and double digits rate of interest also, right? So this will play a role, and bond yields in our case can also inverse, but the entire globe actually prefers to take a look at the 2-year and the 10-year bond yield of the US markets, to be precise. In Indian markets, I have a chart on bond yields, but they do not correlate so much well. So here we are, the factors that we just discussed. The Russia war, direct impact, crude, inflation. Countries who import crude and rely on crude heavily will have to face the price, and we are facing it. And so that's not good news for the markets. Markets don't see it as a very strong sign. And from the US point of view, inflation has been going up there way before the war. And so the yield curves have inversed a little bit for a day or two, but it's very close to each other. And rate of interest are going up there and may go up, continue to go up. And this may lead to recession, This may take us a couple of quarters time. Now let's talk about the state of the market. So the state of the market, where we are and what can we expect in terms of trend and volatility. We'll take a look at the market from the perspective of short-term trend and the long-term. Let's first talk about the short-term trend in terms of what kind of a trend it is. It is downtrending and volatile, and what are the levels that we should look at. So let's go to the chart now. We are here on the Nifty near-month futures chart, and for the short term I will use the daily charts and I will use the weekly charts for the intermediate to long-term view. 10 consecutive negative days. Market back to its previous swing lows, which coincides with this level. All kind of indicators, oscillators will give you readings of oversold nature. Sharp sell-off, there is no doubt about it. The moment it broke away from this range, it just picked up momentum further on the downside. For the week ahead, considering we had 10 consecutive falls, we should expect that the market can stabilize a little bit and give us a bounce back. Here I am taking a look at the 75-minute time frame, and we don't notice any significant bounce back. The last significant bounce back was up here, and this was the 29th of April. After that, you can see that prices have not even crossed my shorter moving average band. I use two bands of moving averages, the shorter one and the larger one. It didn't even cross above the shorter one. So at least cross above that, which means at least go above this level. This is 16,100 as the immediate resistance. And 15,700, 15,600 will be immediate short-term support for the index. This kind of a fall generally leads to divergences. So we can see these kind of price momentum divergence shaping up. In the short term, it is downtrending. It is volatile. It's very difficult to say that whether it will bounce back exactly from the previous low, which was 15,676, but 15,500, 15,600, or this wide gap that I have, wide range, I'm sorry, this is the support zone from the short-term perspective. I am anticipating support. The prices have not yet delivered any confirmation, yes, it is support. So until and unless the prices show that to me, yes, from the anticipated support I am bouncing back, I cannot confirm. And so the least that I can expect is at least give me a move above on a day-to-day basis the previous day's high. One good thing you will notice what happened yesterday is on a day-to-day basis it has made a higher high and higher low. Though it slipped, though it flipped from its intraday highs and it fell and it was a very weak close, but when we take a look on a day-to-day basis, it's not a bad sign. So that's why I'm saying at least go above the last day's high. That is the bare minimum that I can expect from price, 16,100 short term. And so for short term traders, right, so for, let's say, if you want to add here, let's say we can say 16,100 is your resistance, and then you have 16,100 is your resistance, and you can look at 15,500 to 15,600. This should act as your short-term support. Strategically, in terms of your strategy for short-term trading, keep yourself intraday only. If you are not into intraday trading, if you used to do those positional holding trades for 3 to 5 days, not the best of times because of the volatility. Even if you pick the direction right on the short side, the volatility might chop you out. So strategy wise, I would suggest stick to intraday only. That's from the short term perspective. Now let's talk from the long term perspective. What is the long term and what's the view and what's the levels? We'll do the same exercise here. Now for the long term, I have written non-directional and volatile. Let's take a look at the weekly chart of Nifty now. So the reason why I've said non-directional, because if you take a look at this zone, we don't actually see a straight down move, a downtrend like a fall a little bit, then another fall, then a little bit. That's a nice downtrend. This is inclined, tended a little bit on the downside, but it's not that well developed because the bounce backs have been significant and sharp. That's why it is not like really angled on the downside, little angular. And of course, the volatility is very, very evident on this chart. Now, in terms of levels, for levels, what I am looking for is I am paying attention to the March 23rd, 2020 low, that's the Corona crash low, to the recent all-time high, which was around 18th of October. So I'm considering the lows of 23rd of March 2020 to 18th of October 21. I have dropped a volume profile and I've dropped a series of Fibonacci projections, extensions and retracements, and I'm trying to find some confluences. Confluence number 1, close to that 16K mark. This is where we are right now. So where we are right now to the levels of this lows, so this low is around 15,500. So 15,500 to 16,000. So let me quickly write down here. So one set of support that you can expect is from 15,500 to 16K. This is one set of support. If this goes, then the next if this goes, then the next range we should focus is here, this one. because this is where I see a decent amount of volumes being playing out. If I mark it on this chart with a rectangle like this, it coincides with couple of Fibonacci numbers for me. I have a decent confluence, and this confluence is around 14,900 to 15k, 15,100, 14,900, 14,900 to 15k. So I can name this S2. I should have named that S1, something like that. Yes. Then the lower end of this box. So this was the upper end of this box. Now let's take a look at the lower end of this box. It coincides pretty well with these lows. This is 14,400. I have no clue whether these levels will actually see the day of light or not. All that we are doing is doing some preparation work. And I feel the worst case scenario, or the extension of this correction to its worst stage, can bring us to 13,200, where I have a beautiful confluence of two Fibonacci projections. So 13,200. So I'll keep it till S4, and let's take a look at which one is possible. 13,200, little below 13,200. This is 12,900, 13,100. So let's say 12,900 to 13,200. Okay, done. Now, if we get in an info line at the current juncture, we are down around 15%, which is a pretty healthy correction. If we go to the upper end of that border, we will be down around 18-19%. The lower end of that border will take us around 23% down, and the 12,900, 13,000 is around 29-30%. I think for the long-term bull market, which you can see very clearly in this kind of a monthly chart, the bigger picture, and if this bigger picture needs to correct further, then I think that these are the levels. We should not be seeing a correction more than that of 12,900, 13,100, 200. That is a 30% correction. Unlikely. It's possible, because you and I, we don't know how bad these conditions, these factors that we just worked out is going to play out. We don't know. But we will have to keep a close watch. I will try and do some kind of a follow-up of the factors, of the levels that we have discussed in this video. So take a look at the factors once more. We have put it down over here very clearly. If needed, I'll add up some more to this as we unfold. And on the downside, on the right hand side, we have the levels written down. So we'll keep this in mind. I hope that you found this approach useful. Excuse me. And let's see what's in store. Oh, by the way, I need to finish it off by sharing with you that what should be your strategy as a long-term investor. For the short term, I said that you should stick only to intraday. And strategy-wise, for an investor, I think this is the right time to do some good homework. Do some homework and find some value stock rather than growth stocks. This is not the time to accumulate or run behind growth counters. This is where you will start to seek value stocks. So do that. If you are not into that kind of an analysis, and this is not your cup of tea, and this is not what you want to do, then the best thing for you to do is invest in ETFs, invest in index funds, and I think you will be far better off in the long term. Thanks a lot for your patience and hearing me out. Do let me know your thoughts, suggestions, and yes, if you like my work, if you think these kind of work should be appreciated, feel free to subscribe and hit the bell icon. Thank you. Take care of yourselves. Trade well and trade wise.